Alright, for this video I'm going to cover a Form 1065 partnership tax return for the 2022 tax year. So this is a sample company, sample tax return. Certainly this doesn't encompass all things that you might see with the partnership, but we are going to cover a lot of the elements that we commonly see across all partnership returns. So I've got one slide in front of us here. Cover some of the fact pattern and what we'll go over. But first, I also want to touch on the other exhibits I have here. So I do have a sample Form 1065 tax return that we'll go through. So this has the 1065, the K1s, the supplementary schedules, and all those statements. And then we do have an Excel workbook here, which is going to have all the financial statements for the company. So I've got side by side here of the profit and loss and the balance sheet for the company. Obviously, I'll go into more details on some of these other items that are highlighted. We've got a cost of goods sold reconciliation for our company here. I've got a book to tax reconciliation, so we'll cover this as well. Right, most often is the case where you're making book to tax adjustments for your company to arrive at taxable income, and then a partnership capital roll forward. Right, so we've got a partnership here with two partners, and it's always a good idea to have a cap roll forward that shows the allocations to each partner. All right, so back to the slide. What are we going to cover? So again, this is a Form 1065 tutorial, a newly formed LLC, and the specific fact pattern we're going to be working with here is for a restaurant business. So now obviously partnerships exist across all different types of sectors, so this one we've just selected a restaurant business. I will be posting some other examples for different types of businesses, but for this one we're going to focus on a restaurant as an example. So we'll go over the financial statements. The Form 1065 that we'll be covering, it'll include pages 1 through 5. So those are the standard pages that are always included with the Form 1065, right? Page 1 through page 5 being the balance sheet, M1 and M2. Form 1125A, this is for our cost of goods sold number, right? So we'll go over that. The 4562 is for assets that are being depreciated or taking bonus depreciation, Section 179, so we'll cover that as well. Schedules B1 and B2, so B1 and B2, so that's a listing of the owners that own a certain percentage or greater of the company, so there's additional disclosures there. And then the opt-out of the centralized partnership regime, so I'll cover that a little bit, and you can kind of go over when and how and why you might want to opt out of that centralized partnership audit regime. And then we'll go over the K1s, right? So the schedule K1s issued to each partner, and then K2 and K3, which are new for the last few years here. Then what we'll see is they don't actually apply, but I'm going to cover them anyway, and I'll discuss why in more detail when we get to them. So we'll also discuss partnership tax just generally, right? So why do we have separately stated items on the K1? Why don't we just aggregate everything and report on one line item? I'll talk about that. We'll go through the basis worksheets, right? So when we get into the K1s for each partner, we'll cover those basis worksheets and why those are important. Talk about the bonus depreciation. So our restaurant will purchase some property, place into service, and so we have to capitalize and depreciate those, but we do qualify for bonus depreciation for that 2022 tax year. Now, bonus depreciation is nice, but in 2023 and going forward, there is phase outs, right? So it's not going to be 100% unless something changes. So if you're watching this in 2023 taxes or later, 100% might not apply. I'll talk about that a little bit more. And then the de minimis safe harbor elections. So these are the tangible property regs. There is a safe harbor for deducting certain purchases of property. I'll talk about that in more detail, and we'll look at the election as well. All right, so now onto the fact pattern. So the fact pattern that we're going to be working with here, we have a newly formed LLC in Florida, and it's formed by John Smith and Jane Doe. So they are friends. They want to partner up and open a restaurant in St. Pete. So John is going to own 75% of the company. Jane's going to own 25%. And by default, when they set up this LLC, a multi-member LLC, it's taxed as a partnership for federal tax purposes. So that's why we're doing the 1065. Now, we haven't made any S Corp or C Corp elections, right? And that's important because if they made one of these elections, well, we're not doing a 1065. We're doing a Form 1120S for a partnership. Now, both John and Jane are actively going to participate in running this business. But what we'll see here is that Jane is going to be more involved, right? So John's still going to be participating, but really he was just kind of the one to put in more capital. And Jane's going to be running the day-to-day. So she's going to be in the weeds, so to speak, on running the business. So she's going to devote 100% of her time to running the business. This is going to be her full-time job. All right, so now let's talk about some of the numbers to get started here, right? So obviously the company needed some money to get up and running. So John and Jane put in $56,250 and $18,750. So John put in the $56K, Jane put in $18,000. And under the operating agreement, Jane, in consideration for her involvement with the company, right? She's doing the day-to-day. She's going to receive a salary as guaranteed payments, right? And so it's going to be $2,000 a month, $24K for the year. Now, John and Jane, they didn't go all in and buy an actual property yet. They're just leasing a space, which is fine. And they can make improvements to it under the lease agreement, right? So what we'll see is that they did make some improvements to the kitchen, and that's where we'll get our bonus depreciation. And the LLC, to make things a little easier, they want to keep their accounting records kind of on a tax basis. And so when we look at the financials, you'll see what I mean there, and that it kind of mirrors a lot of the same accounting treatment we would for, let's say, the bonus depreciation, right? So they're going to take bonus depreciation and they'll use the same kind of accounting for book purposes rather than like a GAAP or a modified book or IFRS or something like that, right? All right, now the distributions to the partners, so those are capital draws, right? Distributions were $6K to John and $2,000 to Jane, and this is in accordance with their ownership interests, right? So total distributions were $8K, $6,000 of the 8 is 75%, so that's why John's getting $6,000 and Jane got $2,000 in capital draws. All right, so now that we've covered that, let's go look at the financial statements. I want to run through those really quickly, and then we'll start looking at the Form 1065 pages. All right, so their financial statements, try to make these relatively simple, cover some of the big ticket items that you would see for a restaurant. So if we start with a profit and loss statement here on the left-hand side, we've got our company, Fake Restaurant Group. Profit and loss is obviously expressed in US dollars. And we can see here it's set up from March 15th through the end of the year. Now, March 15th, because that was the day the entity was set up, right? It doesn't have activity prior to that because it didn't exist. So we've got our revenue up here, food and beverage sales. So these are the gross amounts of sales separated by category. The cost of goods sold, right? So these are inventory numbers, right? So inventory is increased by purchases, and it's reduced by cost of goods sold, and the cost of goods sold are a deduction, right, in arriving at book income and for tax purposes as well. So we'll go through those numbers in more detail when we get to the 1125. And then down here we have our expenses. So we've got wages for our employees, the payroll taxes, the guarantee payments there. So guarantee payments, those are the payments to Jane. That's her salary, right? So guarantee payments are deducted in arriving at book income and taxable income for the partnership. And then the guarantee payments are also separately stated on Jane's K1, right? So we'll see that on Jane's K1 when we get to it. They got the renter expense, insurance, computer equipment. So they had to buy some computer equipment, a couple of components. And so the $1,500 cost there, we're just going to write that off completely. And we're writing that off under the de minimis safe harbor election, right? So even though the computer equipment arguably could last for 4 or 5 years, you don't have to capitalize and depreciate everything, right? Under the de minimis rules, you can just expense it as like you would materials or supplies. And so that's what we've done here. Now, legal fees, $1,200, payment processing fees. And here we can see the depreciation expense. So if we look at our balance sheet, we did capitalize the improvements, the additions to the kitchen equipment. And the depreciation expense, we are going to be just writing off the whole thing as bonus. So that's why we've written off the entire value, and the entire depreciation expense number is reported here for book purposes, and we'll see this for tax purposes. Now, if they kept their books under a different method, let's say they were using US GAAP, well, maybe they would have depreciated this over 7 years, so we wouldn't see a full write-off in the current period. It would just be a portion of the total asset value. But in our case here, they're not too concerned with keeping GAAP financial statements because they don't do any of that kind of reporting. So they're just making the book numbers match tax. Fines and penalties, so $400. Let's say they miss some licensing fees or something like that. Fines and penalties are a bit interesting because they're actually not deductible for tax purposes. So it's still a business expense in that you had to write a check. So you get to write it off for book purposes. But for tax purposes, it's non-deductible, and that's under Section 162F. And so I'm highlighting that because we'll have to have a book tax adjustment for that component. And then charitable contributions. So charitable contributions, an expense of the business, right? They made a contribution to charity. But these items are separately stated. By separately stated, what we mean is that they have to be separately stated on the return and on the K-1. They cannot be lumped in with all the other ordinary trade or business activity here. And so I'll show you how those are reported on Schedule K. And then there's some interest income, right? So they earn some interest on their savings account, $271, and that is also a separately stated item as well. And so we can find this in subchapter K. Section 702A7 covers these kind of rules on separately stated items. These other items, right? 702A4 highlights how we have to separately state charitable contributions, and most other items fall under A7 there. All right, so now the balance sheet. So pretty straightforward, right? They've got checking and savings account, security deposit, right? That was for leasing the space. There are their end of the year inventory costs by category, right? And then their kitchen improvements, accumulated depreciation, net fixed assets. So their total assets are $127K and change. And then on the liabilities side, we see some accounts payable, payroll liabilities. So that's salaries and wages and payroll taxes due, and then their credit card balance. In the equity section, we separately state the amount of contributions and distributions for each partner. Now, if you have a lot of partners, then you'll have a separate capital roll for, but maybe you won't separately state them on your financial statements. In this case, because it's just two partners, it's okay to separate them. It makes it a little easier to kind of see the money moving in and out for the partners during the year. And then the net income number is being pulled from the net income or loss per books, right? So total liabilities and equity matches total assets. So we know that our balance sheet and P&L are, reconciled. The balance, everything looks good. And so we're ready to go. Okay, so let me go back to the return itself, and we'll start working through some of these pages. So the 1065 return for an initial year, a few things you need to get right up here at the top. So when it asks us for the period here, so calendar year 2022 or tax year beginning, we've entered March 15th here through the end of the year because the company didn't exist the whole year, right? It was formed on March 15th and started operations then. So it's more appropriate to enter the start date and then obviously the end of the year date there. If this is a full year, full calendar year, so it's not an initial return, then you can leave these blank and just say full calendar year 2022, right? That would be fine. Business activity and product code, so that's a product code for restaurants. Tax ID number, obviously, date business was started, and then the name of the partnership and the address, right? So we've also marked initial year return there because it is our first year return, and they've elected to use the accrual method for tax purposes, and that's fine, right? They could certainly probably get away with cash because their gross receipts fall underneath the thresholds under the code, but they've decided, well, let's just go with the accrual, and that's fine, so we've selected that. All right, so now how's the return kind of structured? So page 1 here is where we report ordinary business income or loss, right? And so what I mean by that is if you are engaged in an active trader business and you have, ordinary trader business income, those receipts and those expenses are reported here on page 1. Separately stated items have different line items on Schedule K. So I'm going to jump down here to page 4. So this is the Schedule K, Partners Distributive Share Items. Line 1 here, ordinary business income or loss, this is the net number flowing through from page 1. All the other line items here are separately stated items that are not included on page 1. So just as a quick reference, we can see the total we're going to arrive at is $13,340. If I go back to page 1, that's the net number down here, right? So ordinary business income or loss, $13,340. Once this page is completed, this net number flows through to page 4, line 1, and then we would have to separately account for, again, all those separately stated items on lines 2 on down to 21. All right, and so we'll cover these in more detail when we look at the book to tax rec. So I think a good first place to start is Schedule B. So we have page 1 here, ordinary trader business, and then Schedule B covers all the other information for the company. Now, Schedule B is a good place to start because it contains a lot of kind of yes or no questions that drive additional elements that you might need to include with the return. So at the top here, what type of entity is this? It's a domestic LLC, right? So it's a limited liability company formed in the United States. That's what they mean by domestic. If you have a foreign company, right? So if it was a foreign partnership or foreign LLC, you might check F rather and put foreign limited liability company. Let's say if it was a Bermuda LLC, but in this case it is a domestic entity and it's a limited liability company, so we've checked this box. Now in section 2 here, it's asking us for some extra information on the ownership, and this is what drives Schedule B1 that we have to include. So it asks us here, did any individual own directly or indirectly 50% or more of the company? In our case, yes, right? John owns 75%. So we've indicated yes, and we've attached the Schedule B1 and listed John's information and his ownership percentage. Line item 3 here is asking information on the LLC's ownership interest. So does the LLC own stock or partnership units in another company? In our case, no. We don't have any other investments held through this business, nor do we have any subsidiary entities. So those are all no. Now, in line item 4, what they're getting at here is if you answer yes to this, you can opt out of completing other types of schedules in the return. Now, in our case, we don't get to opt out because our revenues exceed $250,000. So in our case, we're entering no, and this means we have to complete Schedules L, which is the balance sheet. We have to do M1, which is the book tax rec, and we have to do M2, which is the capital account reconciliation. Now, even if you do check yes, you can still complete those schedules, and I often do, right? I will complete those even if we have a small partnership here that doesn't meet these standards. Question 5, is this a PTP? No. We didn't have any debts that were forgiven or canceled. No material advisor issues. Line 8 is very important here, right? If you have interest in foreign bank accounts, either the partnership has signature authority over it or actually opens a foreign bank account, you might need an FBAR filing. Very important not to miss those because the penalty for failing to file FBARs is quite substantial. Okay, interest in foreign trusts, no, and no 754 elections were made, right? So we don't have any adjustments because we had, partners coming in and out, any kind of outside sales that required adjustments of the assets. Now, the rest of these items, all again, no, because we don't have any unique issues here. So no distributions, no partnership distributions to partners, tenancy and common issues, right? Nothing weird there. No foreign branches, so no 8858 filings, no foreign partners at all, right? So we have all domestic partners, so we don't need to worry about 8805 or 8804s. no foreign partnership interest. We did check yes for the 1099s, right? So we made some payments to contractors. We had to do the 1099, so we went ahead and did those, and we indicated yes for both of those questions. No interest in foreign corporations, and so on and so forth down the list, right? So I won't go into all these in too much detail, but the point is, fortunately, all no's given this fact pattern. Now, line 30, the centralized partnership audit regime. So we are opting out of this, and so what this means is, if the IRS determines they want to audit the activities of the partnership, they have to basically audit each individual partner, right? And in contrast, if you don't elect out, then they can just audit the partnership directly and then kind of push the adjustments on, or the partnership could rather push the adjustments on down to the partners. But in this case, we've opted out, and that's generally the better route to take now. Okay, so that goes Schedule B. We're back here to Schedule K. I think now the best place to start with the financials is with page 1 and the financial and the profit and loss itself. So let's jump back up to page 1 and let's look at the financial statements here. So on page 1, remember, we're only entering the ordinary income and expense from the company. A lot of these items that are required to be separately stated cannot be included. And so that's where a book to tax reconciliation is pretty handy. So on the left-hand column here, I have book income and expense. So the total receipts, cost of goods sold, all the expenses. So the net income or loss per books matches the net income or loss per books. And then we have a second column that covers items that should be included in page 1. And then a column on the far side that shows the items that should either be separately stated completely or also separately stated. So on line 1, or page 1 rather, we have the revenue and all the expenses. The items that we're pulling out are the fines and the penalties and the charitable contributions and then the interest, right? So remember, fines and penalties are not deductible, so I can't include them on page 1. It'll be just recorded as a non-deductible expense. The charitable contributions aren't included in page 1 because they have to be separately stated. So that'll be separately stated on Schedule K. And then the interest, right? So the interest income, the portfolio interest income we have here from the bank account, that's not included on page 1 either. That's going to be separately stated on Schedule K. So once we enter the appropriate expenses that should be included, the net income or loss that we're going to see on page 1 is going to be $13,340, right? So $13,340, that's the piece I have here, right? So we've entered the gross receipts. The cost of goods sold is coming from 1125A. I'll jump down to that really quickly. So cost of goods sold, the reconciliation here. Inventory at the start of the year is 0, right, because we didn't have any inventory. Purchases are exactly that. It's the purchases during the year that were added to your inventory balance. And then the cost of goods sold is what you sold to the customers, right? And then your inventory at the end of the year is everything that's left over. So you go count what's on your shelves, or if you have a elaborate POS system that tracks all this for you, these should be the important numbers that you're arriving at. And then it asks us, what method are we using to value our inventory? It's just the costs, right? So we're not, revaluing and doing any fair market value adjustments or anything bizarre like that. So we just have cost value for the ending inventory, and then that's that. All right. So we've got our gross profit there, and then all of our expenses, right? So salaries, and it does note here, right, other than to partners, right? So partners are not W-2 employees, right? So the salaries and wages, this should only be the non-owner employees of the business. The guaranteed payments are those salary payments to the owners, and so that's what we have here on line 10, the $24,000. We've got our rent, taxes, and licenses in there. That's the payroll taxes and the licenses. And then other deductions, we have a statement that just has exactly that. There's other deductions that didn't have a specific line item already pre-printed here on page 1. And then the depreciation expense, right? So the $15,900, That's our bonus depreciation. So if I go to the page 4562, okay, so this is our depreciation and amortization form, basically broken out into three parts here on page 1. So we have the 179 expense in part 1, bonus depreciation is in part 2, and then maker's depreciation. So this is just if we didn't take a 179 or a bonus expense and we just decided to capitalize the property and then depreciate it over a term of years, we would see that stuff down here, right? Asset placed in the service during 2022 using general depreciation. All right, so if we go back up to Schedule K, see where we start to enter some of the separately stated items. So again, partners distributive share items, right? Page 1 flows through to line 1 for ordinary business income. To the extent you have any other items that are listed here that have to be separately stated, they are in fact just separately stated on the Schedule K. And so all these amounts will flow through to the Schedule K1s for each partner in a separate fashion. So what had to be separately stated? If we go back to our book to tax reconciliation here, the first item we had on our list was the guarantee payments. Now, guarantee payments are a bit unique, right? Because it was allowed to be deducted in arriving at line 1 ordinary income, so we left it on there. But it also has to be stated again on the Schedule K. And why is this, right? So if I look at the Schedule the Schedule K here, you can see here we've reported the guarantee payments for services totaling $24,000. The reason why it has to be reported here is because this needs to then flow through to the Schedule K1 for the partner that earned it. And the partner that earned it, when they report this income on their tax return, it's going to be subject to income taxes. So the $24,000 there, remember, that was paid only to Jane because she's the only one working for the company. Or rather working for the company in exchange for the guarantee payments, right? John was working kind of high level, but he wasn't getting guarantee payments. So I'll take a look at the K1s here very quickly to show you what I mean. So this is John's K1, and the K1 shows an allocation of the items to each partner. Now you can see here on lines 4A and 4B, these are zero, right? And this is because of all the $24,000 that was paid. All that went to Jane, so it has to be specially allocated to Jane. John doesn't get any of it. So if I scroll through really quickly here, let me find Jane's K1. Here we have Jane's K1, again, an allocation of all the items, but you can see here the guarantee payments for services, she's getting the full $24K, right? And that's fine, right? Because she did, in fact, receive $24,000 in compensation during the year as guarantee payments. John did not. All right, so that's fine. All right, so if we go back to Schedule K, so the $24,000 is separately stated there, but again, it's also included on line 1 or on page 1, right? So page 1, line 10, we do get a deduction for the guarantee payments to the partners. All right, so now the other separately stated items. So remember, interest income, there was $271 of interest income. That is separately stated here. It's not included in line 1. Charitable contributions reported down here on line 13A, right? $1,000. Again, it's separately stated. It's not included in line 1. And then 18C, that's the non-deductible expenses. That was the fines and the penalties for $402. And then the distributions of cash and other securities, $8,000. Remember, that was the capital draws, $6,000 and $2,000 to the partners, right? And so that $8,000, we can see that on the financial statements, right? So the distributions to John and Jane, there's the $8,000 amount. And then if we look at the capital roll forward as well, we can see John and Jane here, they're getting capital contributions, and then the distributions to each, right? So again, John received $6,000, Jane received $2,000, and then $8,000 rather is reported as a distribution in Schedule K. Now, all these items again are going to flow through to Schedule K1. And the item L reconciliation for the capital account, I'll cover those in more detail as well when we get to them. Now, the self-employment section. this is really important, right? So the net earnings from self-employment is the amount that is being allocated. So at the partnership level, the partnership is kind of determining whether or not the allocation of these earnings are going to be self-employment income for each of the partners. Now, how do we arrive at the 37,340? How are they calculating that? Well, the 37,340 is a combination of the ordinary business income or loss, right, plus the guaranteed payment amounts. So when Jane looks at her K1, she's going to see her self-employment allocation of $24,000 plus the component of the 13,340 that is allocated to her. John, in contrast, is just going to see an allocation of the ordinary business income or loss up here because, again, he's not getting any of the guaranteed payment amounts. Now, the gross non-farm income element there, that comes into play because when taxpayers compute their self-employment income, there's a non-farm method to compute your self-employed earnings and then a farm type method. And so in order to accurately complete those schedules, you need to know the amount of self-employed earnings that's attributed to non-farming activities. And so that's why that additional 14C element is provided for the partnership and the partners that are getting a K1. All right, so now that those are addressed, I want to go on to the balance sheet next. And the balance sheet is very helpful because this is kind of, in my opinion, where it all starts to pull together. So the balance sheet comprises a couple of components, right? So, or at least page 5, rather, of the 1065. So we have an analysis of the net income or loss up here, right? And it's separated by type of person or partner, rather, right? So a corporate partner, an active or passive individual, and then whether they're general or limited partners, right? And so depending on who the owner is of the partnership that's getting a K1 and their participation in the company, the allocation of their earnings is going to be put into the appropriate box. In our cases here, this is an LLC, and with LLCs that are partnerships, all partners are deemed to be limited partners, even though they might be managing members. And so that's why all of the income that's being allocated to Jane and John is all individual active income. They're actively participating in the company, so this is not a passive activity to them, and they're all limited partners. So that's why we're seeing that element in line 2B. Now, Schedule L is the balance sheet per books, and then M1 is the reconciliation of book income to taxable income, and M2 is the partner capital account roll forward, right, or the reconciliation, rather. So Schedule L, pretty straightforward, right? We're just entering the balance sheet as we have it on the internal books or records, right? So if I look at our balance sheet per books here. So again, we've got the assets up here, the bank accounts, the security deposit, our cost of goods sold, our ending inventory number, the fixed assets, and the depreciation, right? So if I glance back at the Schedule L really quickly, you can see here we've got the cash balance, right? There's our ending inventory number, right? That matches the 1125A, and it matches the our balance sheet per books. The security deposit there, $15,000, that's fine. And then we can see here the buildings and other depreciable assets. So there's the $15,900. Those are the additions to the kitchen. And then the accumulated depreciation is the bonus depreciation, right? So we wrote off the entire amount in 2022. Now on our liability side, again, relatively straightforward. We've got our accounts payable balance. The $6,500, that's a combination of the credit card balance and the payroll liabilities there. And then in the equity section for partnerships, we really just report one consolidated number, right? So the total ending balance of the partners' capital accounts. Now the next item down here is the Schedule M1, right? So the reconciliation of income or loss per books with the analysis of net income or loss per the return, right? So this ending number here should reconcile with the number reported up here on line 2, or in section 2 rather, so that total. Now what's happening here with M1 is, again, at the risk of restating the obvious, we're having a reconciliation of our net income or loss per book. So there's the 12,209 number, right? That reconciles with our net income or loss per books here, right? So 12,209. So we're reconciling that with the any kind of book to tax adjustments that are required to get to kind of our ending taxable income for the partnership. So some of the adjustments that we commonly see here are, first, the guarantee payments to the partners. Now, the $24,000 in guarantee payments is being added back for this purpose because, remember, Jane's taxable income is going to have to include her allocation of guarantee payments on her K1, plus effectively the ordinary income or loss allocation to her, plus all the other items, right? So the interest income and the like. And so that's why there's an add back here, because when we look at Jane's tax return, or sorry, not her tax return, but her K1, when we add up all the taxable items, she is getting pushed back this $24,000 of guarantee payments because she has to report this separately on her return as income. Now, line 4, expenses recorded on books that are not included on K1, lines 1 through 13D and 21. These are items that are those non-deductible items, right? So we've included the non-deductible fines and penalties there for $402. So that is also an add back in arriving at our overall taxable income. And that's it, right? So we don't have any others to make adjustments for. Now, some common adjustments that you might see are certainly depreciation. So again, if you are keeping your books under a US GAAP method, for example, your depreciation for GAAP is going to differ from your depreciation for tax purposes most often. And so you will have likely some depreciation adjustments either on line 4A or it could be 7A, right, depending on which way it goes. So in this example, because our depreciation matches book, we don't have one of those adjustments. We just have the add back for the guarantee payments to Jane and then the adjustment for the non-deductible expense. Now M2, the analysis of the capital accounts, this should mirror kind of what we see in our capital roll forward, right? So beginning of the year, right, there was no capital because the company was set up in the current period. So our capital contributions, this is the total for the partners. So remember, $75,000 was put into the company. So if we look at the capital roll forward here, we've got our $75K from Jane and John, so that's the total. We have our distributions of 8, and then our net income or loss per books is the $12,209, and that's being allocated to John and Jane accordingly. So if I go back to the return here, we can see that again. Okay, there's that $75,000 in cash contributions. There's our net income or loss per books, and here's our distributions of $8,000, and then the balance at the end of the year. That's our ending capital. Per the roll forward, per M2, per Schedule L, right? So 79,209. We have the same number up here, 79,209, and that agrees with our financial statements as well, right? So we've got our roll forward there amount. There's the 79,209 piece, and then the same reported on our balance sheet, right? So an aggregate of all those is the $79,209. All right, so once all those items are entered, I think now we can start to look at the K1s themselves. So remember, the K1s that are going to the partners are going to be an allocation of what we see here on Schedule K. So think of this as kind of the totals amount. So this is where you see all the totals, and then they are allocated to the partners in accordance with their partnership ownership percentages, or they could be specially allocated, right? So partnership agreements can provide for specially allocated certain items, even though they might differ from your ownership percentage. So if I jump down to John to start here. Okay, so we've got John Smith. Here's his K1, right? So the K1 kind of mirrors what we just saw on the previous page where the Schedule K totals, right? So we have line items for ordinary business income or loss, guaranteed payments, interest, And this is how everything is being pushed or allocated across all the partners in the group. So we've got our same period up here, right? So again, it's not the full calendar year. It's March 15 through December 31. Information on the partnership, so ID, partnership name and address, and then information about the partner in part 2, right? So John's name and address, his social security number. Item G here, we've indicated he's an LLC member manager, right? And that's fine. That's consistent with the partnership agreement. And then in H1, it asks us whether this person is a domestic partner or a foreign. Remember, domestic meaning, are you a U.S. person for federal tax purposes, or are you a non-resident, so a foreign person? In our case, both John and Jane are U.S. citizens. They live in Florida, so they're domestic partners. Entity type of the partner, John is an individual. And then here we have his allocation of profit, loss, and capital. Now, in this case, everything is just 75%, but that's not always the case, right? A lot of times, partnership agreements might provide for different allocations of income or capital. Now, in item L, this is a reconciliation of the partner's capital account. So we can see here that John had, and this should be unique to each partner. This is not a total. This is unique to the partner that is receiving this K1. So John can see here that, okay, I put in $56,250. I was paid out $6,000. There's my distribution amount. That $6,000 is also reported up here on line 19A. So in line 19A, here's a distribution figure. And then his ending capital account is $59,407. So this agrees with the partner capital roll forward, right? So our roll forward here is trying to kind of recreate what ultimately we're going to see on the K1s. So John's reconciliation down here looks pretty good. Now, partner share liabilities. So partners, when they're allocated liabilities, they can use these liabilities to increase their basis in the company, right? This is unique to partnerships. S corporations don't really have this luxury. There is an ability to increase your basis for loans you make to an S corp, but not third-party debt. So this is John's allocation of the partnership debt. So John can use this to increase his basis in the units, and this helps if John were to be allocated losses, for example. Right, and we'll look at the basis schedule on the next page in a bit more detail. Now, if we go back up here, remember, this is an allocation, so a 75% of the total allocation to John, because that's his ownership percentage. So the ordinary business income or loss was roughly $13,000 or so. John's getting 75% of that. Remember, the interest income, John's getting 75% of the total, so that's why he gets $203. The charitable deductions, right? Remember, that was a $1,000 charitable deduction. John is getting $750, right? 75% of the $1,000 amount. So 13A is the charitable contributions line item. Now, if we scroll up here, self-employment earnings and loss, again, that's a 75% allocation of the totals. There's John's distribution amount. And then 18C is the code for non-deductible expenses. So remember, the non-deductible expenses were the $402 or so of the non-deductible fines and penalties. And so there's John's fines and penalties amount of $301 being allocated to him. Section L, the current income or loss. So this is a reconciliation as to how we arrived at this line item, right? So the current year income or loss allocated to John was $9,157, and this is the breakout of the amounts, right? So he's being allocated $10,005 of ordinary income, interest income. He's allocated the charitable deduction of $750, and then a decrease for the non-deductible penalties and fines, and so that's how he gets the $91.57 amount. All right, so now let's talk about John's basis worksheet, right? So I'll come back to the QBI one later, but partners basis, this is really, really important. All too often I see partners in partnerships and S-corps not properly tracking their basis, and it can create a lot of problems, particularly if you go to sell your investments, so the units in your partnership or S-corp, or you're being allocated expenses that exceed your basis, and so you shouldn't be deducting them. So the way your basis works is you are increasing your basis for contributions you make, so capital contributions you make to the company, allocations of profits, so income. It's being reduced by distributions to you during the year and decreased by expenses being allocated to the year. And then at the very end of it, you're basically adding your capital account to your allocation of liabilities, and that is ultimately what your ending adjusted basis is going to be. Now, I won't go through the worksheet completely because there certainly are a lot of line items, but we can see here line 1, adjusted basis from preceding year, that's 0, right? Because again, his basis at the start of the year was 0 because the company was founded during 2022. So after John accounts for his cash contributions, his allocations of the income, right? So the ordinary income, interest income, reductions for the cash distributions to John, reductions for non-deductible expenses, reductions for charitable contributions. The ending basis is $95,831. So that number is his capital account plus his allocation of the debt at the end of the year, right? $95,831. So kind of a quick and dirty check. If you look at his item L rec, let me pull up a calculator here. So we can see his ending allocation of liabilities is $36,424, and then $59,407 is his ending capital account. So if we look at $59,407 plus $36,424, there's our number, right? So there's the $95,831 amount. So that is John's ending basis in the company. Now, these same allocation principles apply to Jane, right? So Jane's K1, this is her K1. Again, all the same elements here about the company. She has a LLC member manager, a domestic partner, and we can see her reconciliation in item L here, right? Cash she contributed, her allocation of the net income, distributions, and ending capital account. Now, the one unique difference to Jane's is, again, the guaranteed payments, right? So Jane's guaranteed payments here are $24,000. So this is going to be reported as income just on her return, right? John didn't get any guaranteed payments, so that's why his guaranteed payment amount was 0, but Jane does have a $24,000 allocation. And again, that's why up here on line 14A, when we look at what's treated as self-employment earnings, $27,335, that's her $24K plus the $3,335 allocation of ordinary business income or loss. All right, now we want to take a look at the Schedule K2 and K3. So let me find Schedule K2 here. Okay, so I want to cover these very briefly because under this fact pattern, you can technically use what's called the domestic filing exception. So if you have no foreign activity and you have just U.S. individual partners and they've basically told you, look, I'm not claiming any kind of foreign tax credits on my personal return, you can opt out of filing these schedules. So Schedules K2 is kind of the total that's being filed with the 1065, and then the K3 are the allocations for each individual partner. So I'll look at the K3 after this, but the K2 we'll start with first. So K2 has a lot of different parts, right? So the parts are listed here in item C, and you can see how in item C, 1 through 12, I basically checked no for all of them except for line item 2. And the reason for that is because all these other ones really do not apply. Like there just wouldn't be anything that we could enter that would make much sense. The one item that does apply is part 2 for foreign tax credit information. Now, I know everybody's thinking, well, there's no foreign taxes on this. All of it is domestic activity, and that's true. But the reason why we complete this is because if a partner is completing Form 1116 on their personal return for their 1040, they need to know the gross amounts of income and expense being allocated to them, whether or not it's a U.S. or foreign activity. And so what we're doing here is communicating not only for the partnership and to the IRS, but ultimately to the partners, that the activity that's going on within this company is going to be U.S. source, right? So column A, and we report the gross amounts of the sales and expenses. So the gross amounts of sales here, again, nothing is foreign source. So that's why you see lines, B through E, nothing's being entered. This is all U.S. source activity. Our sales, net sales is $292,216. So how did I get that? Well, net sales or gross income is defined as gross receipts net of cost of goods sold. So the 292,216, if I jump back up to page 1 here, is our gross profit, right? So that's why we're not reporting the total receipts, we're reporting gross profit net of cost of goods sold. So the 292,216 are those gross receipts. So that's why that's being reported there on line 1. And then if I scroll down here to part 2, again, part 2, section 1, I'm just on the second page. The amount of interest income that was paid into the company during the year that's being allocated, again, all U.S. source interest, right? So this would certainly be relevant if we had interest coming from foreign sources. We would want to have it separately categorized as such. But again, this is just U.S. bank interest, so we have $271. And then it does a nice total for us at the bottom, a total gross income, $292,487. And then in part 2, section 2, we have our deductions, right? So the expenses allocable to sales income, those are all the expenses that were deductible on page 1. Minus the depreciation, right? So we separately stated the depreciation here, right? There's our bonus depreciation. Charitable contributions separately stated here. And then I also separately stated the non-deductible expenses, and then we can attach a statement saying, okay, we have other deductions here, 402, but those are non-deductible. And then basically everything else that was reported on line 1 is lumped into this expense category here, right? The expenses allocable to the sales income. And then in this case, it does actually foot in that it matches our book income or loss. So when we look at our net income or loss here on line 55, we can see $12,209. That reconciles with our book income, all right? So our book income or loss per our financial statements, $12,209, and again, that reconciles with our M1. All right, so once this is done, now all these items then flow through to the K3s for each partner, right? And so again, remember, the information that's being provided here is important if a partner is going to be, if a partner has foreign tax credits and needs this additional information in order to complete the 1116, right? Because remember, on the 1116, you have to report gross amounts. You have to report gross amounts of your allocation of net sales, gross amounts of interest. All this has to be separately stated. And this is why the K2 and K3 are necessary, right? Because if I look at page 1 of the K1, that's just a net number, right? That is our net allocation of our ordinary business income or loss. I can't see just by looking at this how much of this is sales, how much of it is cost of goods sold, how much of it is all those other expenses. So that's why the K2 and K3 are important. Now again, the company here in this fact pattern likely qualifies for that domestic filing exception. I'll put a link to the video below where I cover that in more detail. So you could have gotten away with not filing it, but I went ahead and did it anyway just for completeness. Okay? All right. So next item on the list, I want to go over the de minimis safe harbor election. So remember on the financial statements here, I noted that the computer equipment, right, this is property with a useful life beyond a year, but we have decided just to expense it, right? So under this de minimis safe harbor election, you can, if you have an internal accounting policy, you can basically say, look, if we have asset purchases under a certain amount, we can go ahead and just deduct them for book purposes, write them off for tax purposes. We don't have to put them up here in the fixed asset category and capitalize and depreciate it, deal with bonus depreciation, 179, none of that. So what we do on the return is we go ahead and we just deduct those costs like we normally would, but we have to attach a statement. So we attach a supporting statement that takes the election, right? So we attach a statement stating that we are going to claim the de minimis safe harbor election, and that's Treasury Reg Section 1263A-1F, and then put in information on the company and then a statement that we're making the election, right? Very important to do that, right? Because arguably, if you don't make the election, then the IRS could challenge the deductibility of the property and say, well, no, actually, you should have been capitalizing and depreciating the cost of the property. Now, these statements here, these are supplementing statements that were prepared, when we did the return in the tax preparation software. So very helpful, just because they show detailed line items from some of the totals on the other form. So you recall page 1 of the 1065 or other deductions line items. So we have those separately listed here, and then the total flows through to page 1. Schedule K, 13A, that's our charitable contributions, cash contributions, subject to the 60% AGI limitation. Our non-deductible fines and penalties. There's an additional statement for Schedule L, or balance sheet, right? The security deposit of 15K. And then again, our M1 adjustment for the non-deductible expense. All right, I think that almost covers everything. I think the last items that I need to touch on a little more in depth are B1 and B2. So let's start with B1. So again, this is information on partners owning 50% or more of the partnership. So part 1 would be if it's an entity, right? So if the owner is an entity in the company. And then part 2 is individuals or estates, right? So in our case, John is an individual, he's a natural person. And so we've listed John's name here, his tax ID number, country of citizenship, and then the percentage ownership he had during the year. So pretty straightforward there. Again, it's just, if you answer yes to that question in Schedule B, where it asks us about the greater than 50% ownership, you've got to attach this B1 and provide more information. Now B2, this is the schedule that needs to be filed if you are electing out of the partnership or the centralized partnership audit regime. So in order to do that, you have to have all eligible partners, right? So notice here, the eligible partners, they've got to be individuals, C Corps, estates, certain foreign entities, S Corps. Notice what's missing, like partnerships, right? So if you have a partnership and then you have a partner that is another partnership, that's an automatic, you can't make the election, right? So in our case, we just have individuals, 2 individuals, natural persons. So we've listed them here, their tax ID numbers indicated down here, the totals for the K1s to be issued. And then of course, on the schedule, Schedule B here, page 3 of the return, we have indicated again here, right? We're indicating yes, we're going to elect out of this regime, and then we've attached the B2 and enter the number of partners. All right, so I think that covers it. Let me just briefly look at this. I mean, we've gone over the financial statements. We've gone over all of these schedules, separately stated items, basis worksheets, bonus depreciation. So I think that covers it for this video. I mean, we're almost an hour here. Thank you so much for sticking with me through here to the end. I hope this was helpful. Obviously, if you have any questions, please feel free to leave me a comment below. I try to get to as many of these as I can. And I look forward to seeing you again on the next video. Thank you.